It's very important we understand the causes of stock market volatility, because once we understand the underlying causes of volatility, we would be able to stay ahead of them, how to mitigate, these causes. Let's examine, causes of stock market volatility. Number one is economic data releases. Economic data releases. And so reports on gross domestic product growth, GDP growth, unemployment rates, inflation, and consumer confidence can trigger volatility as market reacts to deviation from expectations. People expect this, and the market reports that. So that reaction generally will then produce volatility. Example, higher than expected inflation may lead to fear of interest rate hikes, and by so doing, it will then, increase volatility the more. Number two is, corporate earning reports. Generally, companies produce their reports, annual, quarterly. So quarterly reports surprises, whether positive or negative, can cause sharp price movements in individual stocks and sectors. Even, market participants expect a particular stock to perform very well. And if that stock disappoints, if the report coming out disappoints, or goes below, below investor expectations, that could lead to investors dumping the shares, and the shares will drop. It would result in sharp downward price movements. In a case where they start above, the performance is above investor expectation, that will produce kind of optimism, and investors will buy in, and they cause the stock market to equally rise sharply. And number three is geopolitical events, wars, trade tensions, political instability can create uncertainty. So uncertainty, will then cause investors to kind of, reassess risk, and this could lead to market turbulence. So market uncertainty, geopolitical instability, wars can create uncertainty, which will then, force investors to reassess their risk tolerance, what to keep and what not to keep, what to buy and what not to buy, what to sell and what to hold. And these actions will then lead to a kind of market turbulence. Number four is interest rate changes. Decisions by central banks to either rise or lower interest rates will certainly impact borrowing costs and investor sentiments. For example, a sudden rise, a sudden kind of rise or hike in rates can trigger, sell-off in growth stocks. Whenever there's rate increase, it could trigger, investors selling off their holdings in growth stocks. Number five is market sentiments and heart behavior. Market sentiments and heart behavior. Emotional reactions like fear and greed often amplifies, markets or price movement. For example, when people are fearful, they will sell out of panic, what is called panic selling. And when people are greedy, they would they will buy. They become euphoric, and that could lead to speculative bubble. So both fear and greed affects the markets. It can lead to hard behavior. When investors are overly optimistic, they move, like a crowd. They will buy shares. When they are overly pessimistic, they will sell off shares, causing turbulence and volatility in the markets. causing kind of speculative bubble as the case may be. Number 6 is unexpected events. Events like natural disasters, like pandemic, like corporate scandals or shock in the market can cause unpredictable price movements. So all these factors are what really generates market volatility or price movements. Number 7 is liquidity and volume changes. So thin trading volumes or lack of buyers and sellers can exaggerate price swings, especially in small cap or penny stocks or illiquid stocks. Whenever stocks are thinly traded, or whenever we don't have there's no sufficient buyers or sellers in the market, this could exaggerate price movements. Number 8 is algorithmic and high frequency trading. Algorithmic and high frequency trading. So automated trading systems, can amplify short-term price movements, particularly during periods of high market activity. You discover that most of these activities in the market are generated by computers, by algorithm, by programs, than by actual human beings. So you see all these fluctuations, activities, they're generated by sometimes, computers, programs, and algorithms. So all these things, all these factors contribute to volatility in the market. These are factors that causes that cause volatility in the markets. So how to anticipate volatility? How do we anticipate volatility? How do we handle volatility? How do we mitigate volatility? Number 1 is you monitor key economic indicators. Monitor key economic indicators. So stay updated on data releases by inflation rates, like data like inflation rates, like on employment figures, and a central bank policy or statements. Make sure that you are conversant with whatever comes out of the central bank, and reports on unemployment, and reports on inflation, because this will certainly affect the market. Number 2, you track the VIX index. Rising VIX level can signal increased volatility expectation. So, a rise in the fear gauge or the volatility index could signal the fact that, investors expect volatility in the future. Number 3 is follow earning calendars. Usually, it comes out every 3 months. You follow the earning calendars. So knowing when companies report earnings help investors prepare for potential stock or sector-specific volatilities. That's why around March, when you expect, the full year result to come out, you tend to experience activities in the markets. Number 4 is observe global news. Observe global news, because finance is global. You may be investing strictly in your market, in your own domestic market, but what happens globally can equally affect your stocks, even in your own country. So pay attention to geopolitical development, trade agreements, and natural disasters that could impact the market. Number 5 is analyze historical pattern. You analyze, historical pattern. So some periods like earnings seasons or just before major decisions tend to experience higher volatility. So you experience historical pattern and see how it could repeat itself in the future, and you could take advantage of such movements. Number 6, assess market sentiment. Sentiment indicators like put-call ratios or consumer confidence indices provide clue about investor mood. And lastly, number 7, you watch trading volumes. Sudden spikes in volume often precedes or accompany heightened volatility. Whenever there's that increase in volume, it usually accompany or precedes heightened level of volatility. So these are what we need to consider as an investor.